Good afternoon. I'm David Kaufman, the CEO of Westcourt Capital Corporation, and I'm joined today by Robert Janson, the President and CIO of Westcourt. Good
Hey,
afternoon,
David.
Rob.
How are you?
Good, thank you. So today we're talking about something that's really been at the top of mind over the last 14 weeks during COVID, which is the idea about investment themes in a post-COVID environment. And what we've done is we've put together a one-pager for people to follow along in terms of the big three themes that we've seen during this crisis as they play out. And we've had sort of a front row seat to be able to see how it is that folks have responded during that period, especially in the ultra high net worth community, some of the mistakes that they've made, how they've reacted in different situations. And also a lot of people, of course, are interested in how would it be that you'd want to put together a portfolio that would be pandemic proof, so to speak. And so why don't we get started and talk about theme number one, which is COVID and behavioral finance, which I know is always a very important topic to you, Rob. You studied behavioral finance for years. And we say right here in the name of the theme, you know, count on it, humans are always irrational. And I know that you've always sort of depended on the fact that humans act irrationally and fall into a bunch of traps along the way.
Well, I think it's interesting because I think, well, one, this is not our last, certainly not our first crisis, and it's definitely not going to be our last. And I think the behavioral side of things rears its ugly head in good times. And so when you overlay a crisis into this, I think it's only exacerbated, and people really resort back to what that gut feel is. And so making decisions when you feel that the walls are closing in on you makes it very, very difficult. And as you and I both know, over the past 14, 15 weeks, we've seen that both with institutional clients, we've seen it with small clients, large clients, on big decisions, small decisions. It sort of is a never-ending cycle for sure.
Right. And, you know, sometimes you can break these down into sort of fallacies and things that people fall into. So, you know, we talk about the sunk cost fallacy, where people get anchored to what the original amount that they had invested into something was. We also see a recency bias, where humans tend to believe that whatever's just happened or whatever's happening now is sort of what the norm is, rather than what the norm is. So what we've done here is we've put down sort of three quotes which encapsulate sort of everything that we heard, especially during the month of March. You know, March 23rd was, we hope, the lows of the entire COVID experience. And, you know, we can sort of start with the one, which is, you know, I should just go all to cash. That way I can't lose money. And no one is immune to fear, especially at a time of a crisis, and a crisis that no one really could understand, because we have to remember that during March, it was totally unknown from a healthcare perspective how this might turn out. But as is the case during all crises in the markets, it's easy after the fact to say, oh, that was just a blip, or, oh, the great financial crisis, March 15th, 2009, the S&P 500 is at 666. And we now look back and say, that wasn't the lowest moment of all time. That was the greatest investment moment of all time. But of course, you don't know that right when you're in it. So, you know, when you had people saying, I should just go all to cash, and that way I know I have enough, you know, the how much is enough is in the rearview mirror.
Right.
If I just go to cash, I can't lose more money. And so how would you have responded to them during that period?
Well, you've brought up a great point, and we both saw it, which is, in hindsight, and we're only 3 or 4 months beyond it, but in March, let's say our portfolios and many high net worth are down, who knows, 4, 5, 6, 8% in their portfolio. And in hindsight, that doesn't seem like a very bad crisis. And if you'd sort of given them that scenario 12 months prior, and you said, listen, we're going to go through a crisis and you're going to lose 6% in your portfolio, or are you okay with that? They probably said, yeah, big check mark. I'm fine with that, because they've separated themselves from that emotional link. But it's very, very difficult dealing with people that are really tied into their emotional state when they're investing. It's very, very difficult to unwind that. So there's a number of mistakes that people make, which is selling out too quickly. You're sort of then behind the 8 ball, and we're certainly going to get into the discussion around inflation. And just when it's visceral, they're not making a rational decision. Someone with $100 million or $500 million does not have lifestyle needs that they need to meet by way of selling everything to go to cash, to then put a meal on the table, pay their mortgage, et cetera. And so originally, when you sort of have almost an indefinite time horizon, true generational wealth, that you're then sucking back to today's problem and saying, I should sell it all immediately, you've foregone that that thesis that yes, I can be investing for 50 or 100 years. And so many times as you know, we play psychologist just as much as advisor, and it doesn't get any easier. I've seen this through 08 and 09, and we're seeing it now.
Yeah.
People are slowly, that temperature is starting to come down a little bit, but yes, often people are falling prey to that.
You know where I found that it became particularly challenging was that for folks who said, okay, I'm not going to sell everything, but I want to sell something, they become so attached to either what they paid for something when they originally invested, or for example, where it was at on February 29th, sort of at the all-time highs. And so that what we had people doing, which, seems so irrational if you take a look at it now, is saying, okay, that investment, let's just say an equity investment, was worth $100 on February 29th, and it's worth $75 today. But another investment that was designed to be less volatile during different market crises, which was exactly the role that they were playing at that moment in time. Well, that one is at my cost base. So I can't sell the one that's at a loss, because once I sell it, I've actually lost that amount of money. But I'll sell the one that is break even because I'm still break even. And I think that what people miss out on is the holistic concept that money is fungible. That if you have $100 in net investable assets on February 29th, and the whole bundle is worth $80 on March 23rd, the question shouldn't be as much which one to sell based on what it was worth on February 29th, but how about which one to sell based on what you think the prospects are for that investment in, say, the next 12 to 24 months.
But you and I have seen that. We've seen that over the past few weeks, which is then the behavioral finance dragon rears its ugly head again, which means that the nauseous feeling that people were feeling in March has now turned on its head. So we go from fear to greed a little bit, because as we've been saying to clients, people have received by way of a gift. No one can understand why the public markets are essentially back up to where they were at the beginning of the year. So we know that the NASDAQ and the S&P 500 are very close to where they were for December 31st or Jan 1. And they, again, were nauseous in March. And now we're saying, you've got a do-over, you've got a free spin. And yet they're still not making use of that free spin. So now that it's reflated back, nothing to see here. Let's keep going. Let's keep chugging higher.
Rob, let's go back in time and think about, what propelled, we're certainly going to talk about fiscal and monetary policy later, because that's when you add fuel, you get a fire. But part of what propelled the markets to move forward so quickly and so far, giving us a narrow V,
very narrow V,
very narrow V, is, FOMO, the fear of missing out. And we have this here in the document where the quote says, I missed the bull market following the 2008 financial crisis. There's no way I'm going to miss this one. Because a lot of people, going back to what we said earlier about after the fact reasoning, is to say, oh, I should have known that in March 2009 that it couldn't possibly be that low forever, and I should have gone all in on the S&P 500. Or I guess you could have just bought Apple or Amazon or Google or Netflix and kind of had the same ride, because those are cap weighted indices that we generally reference. And so I think that you saw a lot of people thinking this is the greatest opportunity. But one of the interesting things about that is that, and so that of course drives prices up. It's a self-fulfilling prophecy. If people think the market's going to go up, then the market will go up.
Well, we saw that over the past 5 years. Every time there was a blip, the market was bought into, right? So we closed that gap.
This is my opportunity, rather than stepping back and doing something a little more rational, which is, for example, reassessing your risk profile. Because what you just said was really important in terms of the free spin. We've talked about this a lot. You get a do-over, even if you didn't feel that your portfolio is adequately diversified heading into the crisis. And even though between now and then the prices have gone up quite substantially, that doesn't necessarily dictate that you ought to stick with your original plan. Because what people often do is they say, my strategic plan is my strategic plan and it's never going to change. And so what we talk about a lot is the idea that most of the time investment decisions are about cutting down trees. And every once in a while, you have to back up and sharpen the blade. And as you back up and say, let me sharpen the blade, I get this do-over now. If I don't want to feel again in the next crisis, whatever that may be, because one of the things that we know is that the next crisis is always very hard to predict, although we're certain that it will come eventually.
Right.
If I don't want to feel that way, then what can I do? We'll get to this later in the conversation about what you might do specifically. But from a strategic perspective, you might want to say, I've been given this do-over, and now I should think about taking advantage of that. So let's go to theme number 2, the similarities and differences between financial crises, and sort of the subname there is "This Time is Different," right? Because one of the things that is the most similar among crises is that so many people say this time is different. You can't learn from other crises. One of the interesting things from crisis to crisis is that that, as it says here, that in the end, all crises boil down to a mixture, like an alchemy of investor confidence, leverage, and liquidity. So why don't you talk a little bit first about investor confidence, because it's something that really does drive asset prices.
Well, and I think it's a perfect point for the same reason that I still, even in working in the financial sector and having many, many contacts, you know that even in 19, you and I could not make heads or tails as to why, call it American markets, but global markets, global equity markets, inflated by 20 or 25%. And so, you know, you ask 100 different people of all different walks of life in the financial sector, that is purely investor confidence. It didn't mean that earnings on the S&P 500 were growing at 20 or 25%. It just meant that the multiple was higher and more accepted, that something could trade, but usually traded at 15 times was now trading at 18 or trading at 19.
Right. And
as soon as you get into that investor confidence that propped up markets in 19 can dissipate in a flash for 2020.
Yeah. And that's really where leverage comes into play, because leverage is your greatest friend until it becomes your worst enemy.
Right.
And so that when investor confidence is high, people are willing, you know, if a little bit of leverage is good, then a lot of leverage must be great. And so what you get is sort of that combination of hubris and leverage, which leads not just amateur investors to make mistakes, but professional investors to make mistakes, because they start, you know, as time passes and you go back to recency bias. And if the recency bias leads you to believe that calm waters all around, it starts to lead to it, in fact, where you kind of forget that the storm eventually will come. And so your leverage levels go up, especially in an era of cheap debt and available debt. It sort of adds fuel to that. And so suddenly you find that you have a highly levered investment or asset that can't withstand the volatility that comes when, as you said, confidence erodes. But then, you know, the other thing is this concept of liquidity. And liquidity, of course, means different things to different people, because you alluded earlier in the conversation to the fact that ultra high net worth investors don't look at liquidity from the point of view of putting a roof over their head or putting a meal on the table. They look at it really from 2 ways. Number one is that I'd like to take advantage of liquidity to get out of something that turns out to be, you know, not what I expected. And number 2 is that they want to have dry powder so that they can allocate or reallocate those monies
in times of dislocation, right?
In times of dislocation. But what happens also is that if you have all sellers and no buyers in any market, and we certainly saw this in the credit markets during the great financial crisis, and again during the month of March, that you have all sellers and no buyers. And so all of a sudden you have no liquidity. There are no transactions unless people start to hit the bid. And so, you know, you can talk a little bit about what it is that you see either in the credit markets or other markets when you get such a lopsided supply-demand equation.
But isn't that fascinating? This is why I'm so skeptical of public markets right now. And you and I have spent hours on this, but think about it. Without government intervention into North American credit markets, where now the Fed and Canada, for the first time ever, is open to buying mortgage-backed securities and corporate debt with term to maturities of less than 5 years. So without that intervention, markets would have pretty much ground to a halt. We don't know where we would have been without that government intervention. And when you start throwing around, we were just joking 5 minutes ago, the T word, meaning trillions, is also can stand for trouble a little bit. So you've got a market, whether it be in credit markets or in the equity markets, that is not trading on any fundamentals. In fact, fundamentals have kind of gone out the window, and they might have gone out the window 2 or 3 years ago, because again, there's no rhyme or reason for some of these movements in the markets other than very cheap, save your money from the Fed or from the Bank of Canada to sort of normalize things. So if that's the definition of a free moving market, which is the relationship between supply and demand, you've now got this heavy hand of government in there mixing that pot up, and without them we wouldn't know where we'd be right now. So that's why we're very skeptical.
You used the word dislocation earlier, and you're talking about the financial markets, but if you really want to see an example of dislocation, moving on to the next bullet here, where it says it always takes much longer to come back from a crisis than the market says that it does. Is that you have this dislocation, whether you want to call it Main Street versus Bay Street or Main Street versus Wall Street, where there were a lot of ordinary people who, leading into this crisis, still barely felt that they had recovered from the last one.
Right.
And the market had told us that the great financial crisis was yesterday's news years ago, when the S&P 500 not only got back to where it had been pre that crisis, quintupled beyond that. And so, one of the things I think that a lot of people have yet to internalize, because in the end, of course, the economy is what drives GDP, and GDP is in the end what drives actual profitability of corporations, especially large global corporations that trade on the S&P 500. So what do you think people ought to be thinking about now in terms of the separation between the economy and unemployment and the market and what it's—
Well, I think you've hit the nail on the head, which is really the economy, or call it the markets, versus the unemployment, which is a factor into that GDP production. Because Goldman Sachs came out with a report about 10 days ago, maybe 2 weeks ago, that stated that only for a glimpse of time, a really short period of time in 2020, U.S. unemployment probably will reach north of 20%. They actually went as far as to say maybe even 25%. That said, they said, there will be an absorption back to a more normalized economy, and we would probably float back down towards a stabilized 10% unemployment by the end of 2020. So
which sounds good, because
which sounds good. Exactly. That sounds like a positive snippet. You could write a headline about that, which many people did. The thing is, when you peel back the onion a little bit and you say 10% unemployment in the US. So right now there's about 40 million people, give or take, unemployed in the US. And when you go back and you look at the most recent great financial crisis, which is again only 10 years ago, unemployment peaked in or around 10%. And so you say, okay, on a best case scenario, Goldman Sachs has this year coming down to 10. That's where we were at the end of the global financial crisis. And when you tie in how long it took the US economy to absorb that unemployment, which means putting people back to work, to go from 10 back down to sub 4% as to where we were before COVID, that took a decade. So that's really the element that I think we're going to watch closely, which is U.S. unemployment, which is not something that Trump can manipulate. They can inject a whole bunch of liquidity into the markets, but it's really, to your point, how does the Main Street guy or gal get back to work to be able to feed their family, pay taxes, produce for the economy? And we're using the U.S. as an example, but it can go, you can talk in Canada, you can talk the Western world, or the world unto itself. But again, that's something that I think is going to take much, much, much longer than we want.
And we'll talk about taxes in a minute, but when it comes down, if you start with the idea of the tax base, that the small business economy, which represents, of course, the majority of the actual economy, the majority of Canadians and Americans work for small business, however you define that, that's certainly the case. There are a lot of those businesses that will never recover from this. And even though it was, we didn't self-inflict the virus, but we did self-inflict the economic pain from the virus. But it's still turning the switch and saying we're open does not suddenly make up for, the lost opportunities, the lost wages, the lost revenues, and does not suddenly mean that people, will return to business as usual. And I think we'll certainly see sort of another great divide. And that divide won't only be rich versus poor, although income inequality will continue to be at all-time highs. And we'll talk about that in a minute. But it's also going to be this great divide depending on what sector you're in. It may very well be that if you are in the logistics business, that you've never had a better and things are great. And if you're in the restaurant business or the movie theater business or the airline business,
you're going through a nightmare. Yeah.
And you're going through a nightmare, and it could be a long time. We've talked a lot about this, about our plans for 2020 Q4 and 2021 in terms of our own travel from a business and from a personal point of view, is that I think a lot of people in Canada are expecting to stay at home, and our home might mean somewhere else in Canada, but this cross-border travel could be significantly reduced. And that has potentially lasting effects on the economy, and something that we all ought to be thinking about. But, that leads us to, the old expression, you can't fight the Fed. And one of the things, Ben Bernanke during the last crisis was, of course, a student in financial crises. And, he is probably the most knowledgeable person on the Great Depression, how it happened and how to get out of it. But, Jay Powell, who is certainly a student from the same class, wanted to act quickly, as did Congress in the US. And in Canada, we also saw, it was one time that everyone could agree that more of a socialist style approach to monetary and fiscal policy. And we can have another chat one day about during a crisis, monetary and fiscal policy have to get smashed together, right? Because the central banks have to work in concert with the governments in terms of how to get money in the pockets of ordinary citizens. But whatever the reason, and I haven't heard anyone say that it wasn't a good idea at the time, we do know that the bill is going to arrive, right?
Well, and the bill might come by way of inflation. Right. Well, that might be the first bill that we need.
So you've got, trillions of dollars added to debts, right? And we don't even know if how big that's going to get, because we don't know how long, this new normal will last. So as we say here, let's talk about that. So you've got inflation, taxation, and then, it sounds kind of inflammatory to write this, but it's civil war. And civil war, of course, takes a lot of different it manifests itself in different ways. But let's talk first about inflation. So the number one thing that all clients say is that their number one objective, and I don't care who they are, is always preservation of capital. What they really mean is preservation of the spending power of that capital. Because if you have $100 one day and $100 after 20% inflation, all of a sudden it's not worth the same amount. So how do you see inflation, coming around? It's hard to diagnose or to be a prognosticator, but it must happen eventually if you pump money into a system.
Well, I think, and we've spent a lot of time thinking about this, and there's not a conclusion yet, but our thesis is that the next 3 to 5 years could be quite ugly. I mean, we've just expanded the monetary base by, I don't have the numbers exactly, but let's just say in circulation, there's 16 trillion US dollars. Now there's north of 20, all right? So we've expanded the monetary base in the world, in the globe, by 25%.
And by the way, that took 2 months in this crisis.
Well,
and that's years in the last crisis.
Exactly. That's a phenomenal point, because Bloomberg wrote a phenomenal article that said, whether it be the Senate and Congress, they passed that injection of capital within, 15 days. Mm-hmm. It happened. Now it was sent to the corporate America, which is differing from the way Canada took its approach, which is sending it to people themselves. Right. But nonetheless, there's more money in the system. And so will inflation come? And beyond just asset bubbles and pricing, I think that it's also going to have a possibly very dire and detrimental effect on the social fabric of our society. And if we can delve into this a little bit, well, let's make this a little bit more about Canada. So anybody right now, wealthy family that has real assets, they've got homes, they've got vacation properties, they might have some land, they might own some agricultural land, they might own timber, etc. Real assets. Now with inflation, arguably those will probably increase in value. When I say increase in value, it's not necessarily increasing their wealth. It's just allowing, to your point, them to keep up with purchasing power. They're not falling behind. Right. Where you do see, and I don't think politicians are thinking about this because they don't think in 5 and 10 year terms, they think in 2 and 4 year terms. Is unfortunately the little guy or the little gal who is working, making $50,000, trying to save for maybe their first home or their first condo. They are going to be left behind by way of, one, they don't have any assets. They are part of the middle class right now. But if massive inflation is to come over the bow and that wave break over the bow in Canada or in North America, their money will arguably lose value as inflation grows. Yeah. It will erode. So their $50,000 of savings to be their next down payment, it will erode year by year.
And here's the thing, the salary that they're receiving is already being supported by government money as it is. And so that if the price of milk goes up, it doesn't mean that their wage goes up by the same percentage. If the price of rent goes up, it doesn't mean that their wage goes up by the same percentage. And they don't have savings. They can't go and say, well, this is the time to break glass in case of fire, because they don't have the savings, already built up. And so, of course, what that leads to is the governments are going to have to find the money somewhere.
Exactly.
And so, we've talked a lot. We've spoken to senior partners at a number of the big 5 accounting firms to try and get, their guess as to how it is that we'll pay back. So everyone knows that income tax will probably go up. That's sort of a given. And even if it doesn't actually have the positive effect of collecting more dollars, it has an optical effect that as long as you can get the wealthy to pay more, that actually plays well from a political standpoint. We have the capital gains inclusion rate, which is potentially going to go up, which will have the doubly bad effect of taxing capital gains higher and creating fewer capital dividends for those people who depend on that as pipelines to have money going from holdcos to personal. You have the idea floated about wealth tax and death tax. Wealth tax is on an annual basis, and death tax would be at the end. And one of the things that I keep reading is that a lot of those things don't get you there. And what does get you there is increasing, the HST by 5%.
Right.
But that's from a political standpoint. If you want to guarantee that you don't get reelected, what you should do is introduce a tax that everybody has to pay.
But see, I think that is the key, which is we saw this in the UK, and Jeremy Corbyn learned a very difficult lesson when he ran and sort of kept saying, well, we'll tax anything that moves. And we don't need to make this discussion political, but what he did, the outcome was, it's when it gets to even the little guy, the realization that even his or her taxes are to go up as well. There is a scratching of the head and saying it's not just about the rich paying more. Like we know that the taxation rates in this country are high already, on whether it be on the G7, G8, G20 basis. And if history was to repeat itself, I saw this firsthand when I worked in Switzerland, where France had put their marginal income tax rates to 60%. They had an estate tax, they had a wealth tax, et cetera. And the flight of capital from that country was staggering. And as Canadians, that would be saddening for at least for both of us as we know it, because again, it really comes down to not managing the coffers correctly.
And you see someone like Francois Hollande, who is a champion of the little person, right? Yeah. That's the whole point. Let the rich pay their way. But when the coffers are not full, you have to turn to, door number 2, because the money has to come from somewhere. And also, we haven't tied that to the fact that if inflation does come, interest rates will almost surely increase, which means the cost of debt, including the cost of government debt, will increase, which means that servicing the debt that exists will increase, which makes the problem ever more so. So coming back to the politics of it all, no matter where you fall on the spectrum, none of us wants to see, I use the word civil war, and I think that phrase can be somewhat inflammatory. But, tell me about, you had a call just the other day. We were taking a look. We love multifamily residential. We'll talk about that later. You had a call from a Seattle-based apartment REIT, and tell me about how you felt about that.
Well, I mean, it's saddening to say, but it makes you your head spin. Obviously, with the civil unrest that's going on in the United States, I think that is it's the symptom of a number of problems. Obviously, people being shut in, huge social problems, whether it be systemic racism, et cetera. And we'll leave that alone for now. But you tie that into obviously people being under a tremendous amount of stress, and you've got somewhat of a tinderbox effect that is quick to go up in flames. And right now, even in just getting a call from Seattle, looking into Seattle a little bit, as we stand right now, it's almost inflammatory when you say you use the word civil war, but it's as close as you can get in some of the big U.S. cities right now to that state.
They have this what the autonomous zone.
Well, Antifa has taken over, I think, 7 or 8 blocks in downtown Seattle. They've given over I think either whether it be the state or the municipal legislature, they sort of gave the keys to this group, and they're well armed. And so it really is. It's head shaking because it's saddening. But that's the state that we've created.
Well, there is a Mad Max. There's a Mad Max aspect to that, which is sort of the scary, dystopian view of things. And there's no doubt that putting, as you mentioned, you have systemic racism and other systemic issues, but perhaps the thing that adds fuel to the fire always is income and wealth inequality. And yes. I can't imagine that someone as an ultra high net worth person could possibly not see that if we don't have a redistribution of wealth to some degree voluntarily, that one will be foisted upon us one way or the other. And whether it's metaphorical pitchforks or actual pitchforks, there is a limit to the degree to which call them the top 1%ers can live their life at the same time that people at the bottom are feeling, no optimism with respect to the likelihood of them being able to advance. The American dream or the Canadian dream being something that a lot of people find out of reach. So putting that aside, if we go to theme number 3, which is, how to pandemic proof your portfolio. And we wrote here a conservative alternative approach. So alternative doesn't necessarily mean that you have to invest in alternative asset classes and strategies. It means you have to take a different approach.
Right.
And so, we often borrow this concept from medicine, which is MRD, which is minimum required dose. So in medicine, the idea, of course, would be that if you have an illness and you have a drug that treats the illness, you should always try the minimum dose that might cure the illness, because it also minimizes whatever side effects may come, that you don't just flush it all into the patient.
Mm-hmm.
You always start lower and you go up. And if we think about the dose as risk, that we've always talked about, take the minimum amount of risk required to achieve your objectives. And since, especially in a low interest rate environment, people understand that their long-term objectives can't be 10 to 12% total returns on their portfolio in a zero interest rate environment. If people accept that 4 to 6% will get them there, of course, we'll have to, going back to how that's taxed, that's a different story. But if people accept that 4 to 6% will get them there, and then they show you a 70-30 portfolio with 70% in long equities, it appears as though they're taking too much of a dose, too much of a risk. And that leads us into point number one here, which is, we say math is a stubborn thing, because math is one thing where you can't create your own facts. And so we've talked a lot about the secret to making money is not losing money. And that's because as powerful as compound returns are, compound losses are much more powerful.
Exactly.
If you're down 10, you need 11 to get back to even. If you're down 20, you need 25. And, if you're down 50, you need to make 100. So the answer is, well, let's not do that. So how do you not do that, right? Now, before we get into the question about the actual asset classes and strategies that might help achieve that, because I know that a lot of people are very interested in sort of rethinking, from a strategic, taking advantage of the redo that we talked about earlier in the conversation, right, is that a lot of this involves investing in the private markets. Not all of it, because there are liquid strategies that are absolute return strategies that actually don't lose money even during markets like this. But a lot of people say, oh, no. The private markets is sort of a bit of a mythology, because you don't have price discovery in real time. And we believe that having price discovery in real time, it rarely will help you, but it could absolutely hurt you. And that's why it says here, the beneficial effect of the lack of real-time public market pricing in the private markets is real. It's a real benefit. So, how do you feel about in terms of knowing what the price of a unit of, say, a public REIT is one day versus knowing what the NAV of a unit would be on the same day?
Well, look, if I rewind all the way back to what we said in the opening remarks, which is if large Canadian families in this instance have generational time horizons, 30, 40, 50 years,
right,
why does it matter that they have that price discovery on a daily basis? So it comes back to the behavioral side of things. Can I sleep better at night as an investor, knowing that my investment is audited? I'm going to get a quarterly mark. Things happen quickly. March will be digested in maybe my Q1 numbers, and it will be published maybe 30 or 60 days after. If you're still abiding by the rules of the investing world, which are above board and the transparency is there, albeit on a lag and a few months late, what's wrong with that?
Right.
I mean, we've often challenged this, whether it be on panels and on shows and in interviews and this sort of thing. I personally, as well as you, investing in the private markets, along with some public investments as well, but accessing private debt, private equity, real estate debt, real estate
right,
equity, et cetera, allows for some dampening of volatility in your portfolio. And that's not a bad thing.
Right. And it's really fueled by two things. The first is that in the public markets, we have the opportunity to have price discovery on a daily basis. But by definition, all of those fundamental investors always believe that the price is too high or too low. It's
right,
kind of like the holidays every year. We always say, oh, they're very early this year, or they're very late this year. We never say they're just right this year.
right.
So that means if everyone believes that the price is too high or too low, that means that the price is probably not just right, whereas the NAV could be. We've also been trained to think in daily, weekly, or monthly increments, by some chance of nature, that what the value is at the end of the month is so important to us. But if you think about it like the home that you live in, most people, and I know that you're a huge fan of surfing MLS in your free time, yes, most people do not try to get a good value on their house on a daily, weekly, or monthly basis. Do I want to live in this neighborhood? Do I have the house that suits my living? Is it well built? Are there good schools? All of the different things that make your house a store of value while you live in it. If you think about it, your private investments can be very similar. Is the strategy one that I'm happy to be invested in? Are they doing what they say they're doing? Is the performance adequate to get me to where I need to be? The fact that I can't get a daily price probably doesn't matter that much. But let's turn, Rob, to actual strategies and asset classes. Now, we've underlined the phrase true diversifiers, okay?
Right.
Because, it's a little bit like, if you sit in row 12 instead of row 13 on a plane, you're not diversifying anything. The plane's
still going to be turbulent, right?
Yeah, the plane is going where the plane is going. So the question is, are there strategies and asset classes that actually prove during actual volatility to dampen volatility and diversify? And there's really two types of diversification. There's diversification against volatility, and there's diversification against inflation, which of course is always something that people should fear. And of course, real assets, as you alluded to earlier, are sort of the ultimate diversifier to inflation. So if we go down this list, we talk about the multifamily income producing real estate is right at the top of the list. This is not a secret. This is not something that people are only discovering now, that the reason that multifamily real estate, income producing real estate, has always been a favorite of intergenerational long-term investors is that people have to live somewhere. There's no anchor tenant risk. People come, people go, but as inflation comes, and normal inflation is 2-3% a year, that you would expect the value of that to keep up over time. That's very different than say running an operating REIT like a hotel, where people rent that by the day and they don't have to stay in a hotel. You have to live somewhere, but you don't have to live in a hotel for a night. And so there's a really big difference between that. So you get steady returns, you collect rent, and we've been very happy to see that during COVID, at least in Canada, that the well-run apartment REITs have collected virtually 100% of their expected rents during that period.
Well, and I think it's important that you said in Canada, because again, I think you can get out over your skis when you take a single asset class. And as the saying goes, real estate is local. Well, let's say real estate is local within Canada, right? I think we all feel a little bit more comfortable to be investing in the multifamily space in Canada, where we can speak with Canadians about Canadian assets. And it is really a different beast in the United States, with different legislation and different people and different profiles and different outlooks. So as you know, we've got exposure to about 18,000 apartments in Canada. Our investment managers have collected rents which are entirely in line with our historical rent collections, 98, 99%. And we're sleeping very, very well.
We saw the same thing.
It's very boring, right?
We saw the same thing during the 2008 crisis, and it kind of makes sense because it helps if you can actually predict, because it makes sense rather than just hoping. And if we move on, speaking of making sense, we have senior secured private debt. So of course, private debt is the darling of a lot of private investors because people don't mind going into the private markets, but they like to be higher in the stack. Now, what helps is that people should never confuse the idea of cheap money versus access to that cheap money. And
right.
So what happens during times like this is that banks tend to retrench a bit and protect their own balance sheet. And so they don't lend to things that they don't understand or that are complex. And that's where you get all of the alternative lenders coming in. So they always exist because you always need alternative lenders. The joke in Canada is that banks only lend money to people who don't need it.
Right.
But at times like this, they really don't lend money. They don't open up the purse strings, which means that alternative lenders have a role to play. And so it doesn't mean that you necessarily will make more money in something like senior secured private debt through a crisis. What it means is that the lender can take less risk because they're standing in the place of where a conventional bank is supposed to be.
Right. There's a vacuum there, which leads to opportunity, right?
Exactly. That they can get the strong covenants and they can get more risk management, even if the return is the same. The risk adjusted return is higher. Speaking of a higher risk adjusted return, the next one on this list is risk arbitrage. And we give an example of SPAC arbitrage, which we're not going to try and explain in any detail. It's a little bit complex to explain briefly, but basically you have these strategies out there that, we talk about the deal with the genie comes out of the bottle and says, make a wish. And you say, my wish is not to lose money. And the genie says, I'll make that deal, but you have to also say that you don't have to make 18% in 2019 when the S&P 500 goes up.
Right.
Right. And so if you're willing to make that bet, you can see risk arbitrage strategies in the public markets, they're entirely liquid, that actually they can even be positive, right? During a period like
well,
this.
year to date, I mean, and the 2 or 3 investment managers that we use within that space, as you know, are doing phenomenally well. They were up 3.5% to the end of February. They lost about 4 and change in March. And right now, year to date, they've had a couple back-to-back positive months, and we're up year to date, sitting mid-June, literally on the 15th of June, about 5%.
And that's good, because in 2019, we did get the other part of the deal with the genie. You know, you're up 7 or 8%.
Right.
Year when others
Right.
are
Exactly.
and you can't experience FOMO then, because you made your own deal, right? You made your, and it's good to know during the crisis that those strategies can work. You know, the next one on the list, farmland. You know, we wrote here somewhat tongue in cheek, gold you can eat. You know, I can't. Well, I can speak a little bit for you, but I can certainly speak for myself. You know, I hate gold as an investment, because gold.
And, you know, we've had this battle many a time.
Yes, we have. It has no intrinsic value, and it may be a store against inflation, or it may not. You know, it sort of depends from time to time. Whereas farmland, and by the way, farmland, institutions figured out years ago that farm and timber are 2 real assets that are very important from the point of view of diversifying against inflation. But also, we're not going to find a time where people are going to stop eating. And the emergence of the middle class in developing markets, the first thing that you tend to do when you get into the middle class is you eat meat. And it takes a lot more grain to feed an animal, to eat the animal, than it does to feed people the grain. Right. And so that demand goes up. I mean, the simple idea is that the amount of arable farmland in the world goes down every year because water is very difficult to access, and the population of the world goes up every year. And so,
well, not only that, is why not borrow a page? You know that we've studied CPPIB's asset allocation. We've studied Yale's asset allocation. You look at Tiger 21, which is also a peer sharing institution in the US and in Canada. And if you take a look and you say all these institutions are investing, to your point, in agriculture, in farmland, in timber, why would a family with 30, 50-year time horizons, again, not try and access that same type of asset class when you have almost an indefinite time horizon? So that's that puzzle piece that where we think that big families, certainly in this country, should be open to those sorts of allocations, even though they're boring. They're very boring.
And
right?
Speaking of acting like an institution, I mean, the last point on the document here talks about infrastructure and other real assets such as self-storage, renewable energy, public-private partnerships. So here's the thing, right? Some of this is accessible to the ultra high net worth investor, and some of it isn't. So you have to be aware of the fact that institutional investors are typically tax exempt if they're pension funds. Mm-hmm. And so if they have a required rate of return pre-tax of 3%, you can't battle against them to go and buy what looks like a utility, which would be like, say, a toll highway or an airport or some big piece of infrastructure like that. Because they will always outbid you, because they can make do with a 3% or a 2.5% return, where most investors know that their real return is negative, because if inflation comes at all, forget about hyperinflation or anything like that. If inflation comes at all, they just won't be able to keep up. So that what's important, we've always kind of joked around that true infrastructure is the uncrackable nut for ultra high net worth investing, because you're battling against that. That doesn't mean that there aren't other investments that look a lot like utilities, because in the end, anything that produces cash flow, any cow that produces milk has value as long as you can harvest the milk and sell the milk. And so I think that all investors ought to be on the lookout all the time for things that look like utilities. You know, whether it on one end is a cow producing milk, or on the other end are music royalties as the world goes digital and no one buys records anymore, but everyone still listens to music and podcasts, and you get these on different ends. And all of that can be considered like a real asset because it walks and talks and sounds like a real asset.
Well, and the governor is often, you will rarely brag about those types of investments at a cocktail party, and yet they are staples, or can be staples, in your portfolio. So boring is sexy to us, for sure.
Well, boring is sexy. That's an excellent way to end this today. Thank you for spending this time with me. I hope that people enjoyed it, and it certainly should be thought-provoking, and we'll be happy, of course, to continue this dialogue, not only with each other, but with people.
Answer some questions. Exactly.
Thanks, Rob.
Thank you.